We've mentioned self-liquidating loans before. One of the things that we need to talk about is the fact that for a loan to be optimally structured, the maturity structure of that loan needs to match the repayment capacity of the assets that are being financed. In other words, a repayment pattern over time that matches the earning potential of those assets. And the structure of these loans really depends upon what the purpose is. A self-liquidating loan is made for the purpose that generates sufficient income to repay the loan within the maturity period. The maturity of the loan and the scheduled repayment must be such that the payments can be met from the cash generated by the investment. If the loan is made for a fixed asset or an asset that has a life more than 1 year, and it's going to be contributing cash flow beyond that 1 year, then the loan needs to be structured in accordance with the anticipated cash flows. Now, when we're financing current assets, most of the time we get an operating loan. These loans are typically used, of course, to buy inputs such as fertilizer, seed, pay labor, buy chemicals, those kinds of things. And those inputs are being used to produce a product. Most often, operating loans are a line of credit. In other words, where the borrower goes into the bank or the lender at the beginning of the year and sets up a line of credit, which gives a maximum amount that can be borrowed on that line of credit. And then as they need the funds from that line of credit, they will take draws on that line of credit as they go through the year. As you see here, operating loans are for the purchase of inputs, and those inputs are being used up in the production process. And so for the self-liquidating aspect of an operating loan is that you're producing a product that will be sold, and then the sale of that product will then be used to pay off or pay back the operating loan. So the operating loan is really self-liquidating in that it produces the product that can be sold in order to pay back the loan. That's one of the reasons that whenever we're looking at a term debt repayment capacity, we're looking at net income after operations, which is after we've taken out operating costs. Because our assumption here is that operating loans, the operating cost is being paid back, so that loan is no longer outstanding. Being the production inputs, these assets are used up or converted in the production process. And generally the lender is going to rely on as a security interest in the growing crops or other fixed assets provided. In other words, the security interest for a crop loan is the crops being produced. The security interest for a livestock loan, for instance, for a feedlot or stocker cattle or feeder cattle, would be the assets that are being purchased, and then they're going to be sold at the end of the feeding period, and those proceeds used to pay back the operating loan. In order for an operating loan to be self-liquidating, the payments should be scheduled to come from income generated from the product sales. And as it says here, the source of repayment for an operating loan is from the cash generated from those sales. Now, when we're financing depreciable assets, in other words, we're talking about here machinery and equipment, breeding livestock, the assets are used in the business over a period of time. Their capital costs are charged against the business in the form of depreciation over the economic life of that asset. And so that asset is going to contribute to the productivity of the farm or the business, and that asset is going to be helping to generate income as you go forward. Now, depreciation, which is a charge against income, is a non-cash expense. It is from the wear and tear or obsolescence of that depreciable asset. And then most depreciable assets provide effective collateral and contribute to the firm's net worth. So the proper financing of a depreciable asset should be synchronized with the loan maturity and the repayment schedule to the cash generated by the asset. And one way to do this is as you depreciate out that asset, that depreciation set aside or charge against income can be used as a source of repayment for that loan. So a depreciable asset, when you charge depreciation against your income, that depreciation, even though it is not a cash expense, that depreciation can be used to self-liquidate that equipment loan. In practice, it's difficult to identify the timing and magnitude of the contributions to profits of depreciable assets. But as we said, however, when depreciation is charged against revenues in the income statement, cash is essentially being set aside for capital replacement, and this can be a source of repayment for that loan. Loan maturity shorter than the depreciation schedule will require a diversion of funds from working capital and therefore reduce liquidity. This is one of the problems oftentimes with a loan that is not structured properly, is that if the loan structure is too short versus the depreciation or the capacity of that asset to pay back, then you have to use funds from other sources, whether it be working capital or most of the time in a charging against your working capital and your liquidity. Now, when we're talking about fixed assets, we're really talking about land, in which, although there's some depreciable assets that may be part of that land, such as buildings and fences and other types of assets. But the loan maturities on farm real estate loans are typically in the area of 20 to 40 years. In other words, you're going to have a maturity here that gives that asset enough time to be able to generate the profits that are necessary to pay it back. So the cash rent equivalent, or profits after taxes and withdrawals for most farms, has not been sufficient to make real estate loans self-liquidating. So therefore, oftentimes, in order for that loan to self-liquidate or to be paid, you have to use cash that's coming from other sources. As I say, most of the time, the profits for, say, a land purchase off of land, oftentimes those profits are not going to be sufficient in order to pay back that loan, so you have to use other sources of income. So the primary source of repayment for long-term loans is from retained earnings. In other words, therefore, when retained earnings are not sufficient to pay your family living withdrawals, you have to reduce liquidity or come up with other sources of income in order to make those payments. So in summary, the sources of loan repayment are operating loans from cash from the sale of the product being produced, intermediate term loans for equipment and machinery loans from the cash set aside for depreciation, and long-term real estate loans from retained earnings, in other words, profits less income taxes and family living withdrawals. Failure to meet any of these conditions indicates that debt has not been appropriately allocated. In other words, the structure of that debt has not been appropriately allocated relative to the repayment capacity of those assets, or the total debt is too great, which often happens is that when the debt gets too great and the business is not able to meet those obligations, then it has a problem with repayment capacity.